We're going to jump right into our next topic, which is a panel on cryptocurrency. So we have Tony Pettapiece, Chairman of GRIP Investments and board member of the Global Digital Asset and Cryptocurrency Association. You ready to go, Tony?
Yes, indeed. So I'm Tony Pettapiece, Chairman of GRIP Investments. It's a boutique investment bank out of Dubai. In the digital asset space, we've focused strictly on security tokens for now, as the regulations there are restrictive, but that is changing. The global DCA has been around as a grassroots movement in Chicago for about 2 years, started among the blockchain and crypto community there. Chicago, you may know, is a big trading town. And we focused on bringing regulatory clarity to the markets and also focused on what we needed to do to bring greater transparency, accountability, and increased participation and liquidity in ensuring a level playing field and investor protection. We have a number of committees within GDAC. The most active of which is the Policy and Regulation Committee. We're building an ecosystem of support for the trading community in the US and globally. We have members on all continents, and we have collaborative agreements with 13, I think, different governments and blockchain associations around the globe. Our membership includes exchanges, market makers, prop trading, crypto funds, Big Four accounting firm, banks, and a host of vendors providing services to the marketplace. We focus on a number of areas, including engaging with the regulators and advocating on behalf of our members. We regularly provide feedback on legislation and consultation papers, and we've done that with the SEC, CFTC, FINRA, FinCEN, FATF, Her Majesty's Treasury, and the DFSA, which is changing their regulations at the moment for security tokens. We're driven by our members' concerns and their agendas, and we've developed standards because of that for AML KYC, cybersecurity, market surveillance, now mining, and also reporting standards. There are already standards for many of those, but they're not implemented globally across crypto firms, as you may know. We're also working with FIX on defining standards for fixed digital assets, and we hope to be moving forward with Jim and crew on that shortly. We also provide an arbitration service for dispute resolution, which is open to members and non-members. And lastly, we're developing a training curriculum which will offer education and certification for crypto trading. And by that, I mean Series 7, Series 3-like certification, where it can be taken seriously by the regulators. We've watched the evolution of the marketplace from a purely retail sentiment-driven market to one with more institutional participation. I was very surprised recently at a webinar with Fidelity Digital Assets when they revealed that they have 125 institutional clients providing custody and trading for those. Many of them are hedge funds and family offices. And Fidelity then mentioned that they're also using mostly market makers to access liquidity rather than the exchanges directly. And our panel can talk about some of the pros and cons there. Digital assets is a growing space with new players, services, and products entering the market on a weekly basis. I'll share this graphic, which I think comes from our friends at KPMG. So Bitcoin ETFs have been approved in Canada, and we believe that when a Bitcoin ETF is approved in the United States, that there will be a stampede of money into the market with a strong bull market for the foreseeable future. So a lot of you are used to connecting to exchanges, certifying FIX, and starting trading. You can probably do that with some of the national futures exchanges here, but for the spot exchanges, only a handful of them support FIX, and it's an imperfect marketplace. So best price, best execution, many of those are unknowns. I'll stop there and hand it over to the panel. I encourage you to ask questions directly or on chat. And if we don't have time to get into your questions or topics, please reach out to myself or any of the panel afterwards. With that, we'll kick it off. Guys, if you would introduce yourself briefly and what your involvement is in the market, please.
Yeah, sure. I can go first. It's John Devine here from BlockFills. So BlockFills, we serve institutions with OTC liquidity for spot, for options markets, futures markets, also lend, borrow. We support fixed API connectivity. We also do order management systems to streamline digital asset settlements and client management, client position management. We operate as a Cayman Island entity. We also have a sister company called Basis Capital Markets, which is FCA regulated, and primarily dealing with institutions that are interested in executing large orders in the spot market via our dark pool. also helping out with options trades to manage risk, and also interesting arbitrage opportunities within the futures markets.
Hi, David Nelly from Haymeyer here, and we are entirely prop company. We only trade against counterparties and on exchanges. We host direct end user to institutions and use FIX as our typical protocol. We trade on a number of exchanges, both crypto type exchanges as well as futures. So we're quite familiar with, and quite used to FIX, having operated in the traditional world, traditional financial world for several years.
Hey everyone, John Tavares here from Crosstower. Crosstower operates 2 exchanges, a US regulated exchange based out of New Jersey, a global exchange regulated out of Bermuda. We also have a prime servicing financing business line and asset origination with the launch of our BTC fund that we just launched a couple of months ago. Crosstower is a digital asset exchange. We provide fixed connectivity to our market makers and institutional customers. Like other crypto exchanges that use web protocols like REST and WebSockets, we offer that as well. And we do this across both of our exchanges in the US and out of Bermuda.
Hi, it's Jerome Dwight from Brain Capital. Great to meet you all. We're a Canadian-based company, and we're primarily a crypto custodian. We are really focused on building a regulatory-first custody platform in Canada, the US, and then internationally. Our technology is one of the safest and most secure. We are ISO 27001, 27017, and also NIST Level 4, which is one of the highest standards in cybersecurity. And fully insured, and we're also blockchain native, which really allows us to be nimble and adapt to some of the new tokens and instruments coming out. One of our core pillars is that we are not in the exchange or trading business. So we have an open API architecture to work with trading platforms, exchanges, and our primary focus is on custodying for family offices, ETFs, broker dealers, and banks. And so we are a Canadian company. We have recently announced that we have completed the submission of our trust charter in South Dakota, and also accelerating some of our entry into Europe, Bermuda, and into Cayman. So we think we've got some pretty cool technology here, and also we wrap around that some very customizable regulatory compliance policies and procedures that we made an investment in, from custom reporting tools that can really be customized for a buy-side investor, an asset manager, etc. So we've got a couple solutions. One is sort of a qualified custody product, which depending on which jurisdiction you're licensed in, we can offer and stand as a qualified custodian. Alternatively, we have sort of a white labeled self-managed custody technology solution, which integrates pretty easily into most platforms, whether you're an asset manager, exchange, etc. So I'll stop there, and great to meet everyone, and happy to answer any questions.
And I'll introduce Ben in the interest of time. Ben is a professor at IIT Stewart here in Chicago. He works with us on the Policy and Regulation Committee, and he is our ISO standards expert. Okay, on to the agenda. It's fairly open. The first topic here is who is investing and why, and I would phrase that as maybe what's changed with who's investing and why. Maybe John, go first.
Yeah, thanks, Tony. So, interestingly, over the past year and a half, I would say, has seen a real dramatic shift in the type of counterparty that's interested in trading with Blockfills. So going from a high net worth individual type client to more of an institutional client, that would be banks, hedge funds, proprietary trading shops, and exchanges as well. Also, interestingly, aside from just spot, we're seeing a lot more interest in risk management through the options markets. So across the board, the volumes for options have really taken off in 2020 especially, and we've continued to see that through 2021. And now with the development of, further development of futures markets across the world, including the CME and ICE, we're seeing a lot more interest in taking advantage of the forward curve as well. So Blockfills facilitates spot trading through our dark pool, where you can execute large institutional orders. We also facilitate options trading for risk management or for speculation. And then we also provide access to the futures markets as well, regulated and unregulated, along with our lending and borrowing business.
John Tavares, please.
Yeah, thanks, Tony. Yes, second that what John Devine said. CrossTower, which launched just a year ago, has seen our customer base sort of shift in that 1 year, where initially it was sort of the crypto native institutions that were coming to us, and in the later half of 2020 and for this year, we've seen more of the buy side, traditional finance, hedge funds, interested in investing into crypto. In CrossTower spot exchanges in the US and globally, we're seeing a lot of interest. As we're building out additional features, we're seeing people ask, well, where derivatives is hot and people want to invest in that. And that's definitely where everyone is headed towards, to hedge their spot positions, even possibly looking at digital gold to hedge some of those positions. So it's very interesting to see that the buy side is very much interested in getting into crypto.
Yeah. So, and I'm along the lines of what I'm hearing from John and John. We've seen a big uptick in institutional participation, and our bias has always been towards institutions, but now we're starting to see commercials get involved. We're starting to see more payments getting involved. Again, investors, larger investors, and institutional have started to get involved. So we've seen a large, a big uptick in demand for fixed connectivity over the last year or so. The other big change has been the world has kind of migrated from relatively unregulated institutions to more regulated. Not that it's been a full migration, but you're starting to see some of the institutions that are regulated in the United States starting to trade with more volume, and they're all fixed users. Increasingly, you're seeing some of the institutions that are, based in New York, Coinbase and Gemini and, others like that, which are regulatory compliant. They're starting to trade more and more. So you're seeing an uptick in what I'd call kind of, institutional grade participation. Along a number of different lines. The other interesting development is what I'm going to call kind of gatekeepers. So there was somebody just mentioned Fidelity, and Fidelity might not want to maintain its own fixed connectivity, for instance, to a bunch of different places, but it might write fixed to a gatekeeper that would then write to a number of different other participants. That paradigm has started to take off. There are a number of people who are facilitating larger, easier access for larger institutions, and that typically what that gives the end user a lot of kind of latitude on what they can do. For instance, they could write to a GUI, which then routes their order to one of the end users via FIX, or they could write to directly, and route orders. And so there's a ton of there are a lot of different kind of paradigms that are out there, but that's been something that's kind of taken off. Few businesses have really taken off accommodating those kinds of transactions over the last year or so. So,
it's Jerome here. Maybe I can comment on the Canadian landscape, given we've kind of led the way with ETFs, and they've been by and large a pretty transformational success story here in Canada. The CI Galaxy Purpose Bitcoin Fund. Some of the highest traded funds, ETFs, in their first few days post-launch, surpassing $1 billion in AUM in a matter of days. Significant institutional participation now, and there's probably a dozen other ETFs coming to market in the next few months in Canada. So we are certainly seeing institutional investor appetite growing. And another area that we've been sort of active in is crypto-backed lending. We're seeing a lot of structured products coming to market, with obviously us as custodian hanging on to the underlying collateral, with some very innovative lending products being structured by institutions as well.
Okay. The next item, we didn't answer why in there, but I think it's because that's where the money is, right? Type of answer. Where to trade, defining the rules of exchanges and market makers. Why don't we have the exchange go first?
Yeah. Where do they trade? They trade on centralized exchanges like CrossTower and all of the other names that are all over the news. DeFi is another area where I think people are dabbling in. It's new, it's hot, it has some tremendous returns, and I know that that's of great interest to people. And outside of the institutions, there's also on the retail side, there's more of the peer-to-peer is something that's also taking off in different markets, primarily outside of the U.S. But peer-to-peer is also a big way of exchanging digital assets between individuals.
Okay, David, thoughts?
And I think I commented pretty much on where they're trading. I mean, I think it's kind of, all the places we mentioned above. So I don't have much more to add on that.
Okay. So when Fidelity talked about their 120 investors, they said they use mostly market makers, which I found a little strange, as opposed to going directly to the exchanges. John Devine?
Yeah, I think the big driver there, although the exchange landscape is certainly sufficient for most use cases, I think the large driver for the OTC marketplace is the aggregated liquidity solutions. So you can really put some big orders into play and not push the market around. And also settlement times, you have a point of contact at all times on settlement and status of that. But really the aggregation of liquidity, I think, drives a lot of the OTC participation.
Right. Like, It's interesting that the CBOE just licensed one of those aggregators price feeds. So CoinRoots is a company that I call it an aggregator, call it a redistributor, whatever you want to call it. Basically allows people to connect to them in different ways, and then sends out the transactions to different market makers typically. So as a proxy, they offer a service called Real Price. Real Price is supposed to be their determination with the most accurate price in the Bitcoin or any of the other coin markets there. And the CBOE just licensed that price. So as kind of an interesting flip on the markets, where you were looking at exchanges to determine the price, they're now starting to look at more and more OTC markets to do so. So if you want to, it's anyway, that was another twist to the market that has kind of come about in the last few months. So
yeah, I think people probably are aware that there is no national best bid offer here. If you want a price, you've got to go to the exchange or go talk to a market maker. They'll give you a price. David Weisberger, who runs CoinRoutes, is probably known to some of you. He's been on the market for many decades and came up with the consolidated feed for the exchanges, which is very nice. And CBOE has licensed that, as David has said, and is publishing an index. The reason they did that is when they initially launched their futures product, they withdrew it from the market because they weren't sure the prices they were using were good. So now they are, and they'll be coming back in at some future stage with another product. The next item on the agenda is custody. And I've been following this market for many years now, and people were always saying, well, when they fix custody and this and that, then the institutions will start to come in. And that's not what made the institutions start to come in. If you listen to the SEC, they talk about protecting assets. But if you've got players like Fidelity, Bank of New York Mellon, Santander, Northern Trust, providing custody, what is the issue? Custody is sewn up, right?
Yeah. Go ahead.
I can comment. It's Jerome from Brain Capital. I guess we're the only custodian here. So I think a couple of things. I think the regulators are still trying to figure out the roles of a custodian. I come from BNY Mellon. I was a Canadian president for a few years, and it's a fiduciary role, and one of the core pillars is you're unconflicted. And we're in deep discussions with Canadian and international regulators about what a custodian looks and acts like in the crypto space, and it's still not set. And I think the regulations are going to change and evolve. Our view is that a custodian should be certainly in the crypto space, be completely segregated from any market making or trading operations. So over the years, custodians have gotten into lots of other activities, including liquidity, lending, etc. And I think given the infancy of this industry, the way our regulators, at least in Canada, look at it is custody should be standalone, very separate. Just conduct the boring, custody piece, and I think that's the way our regulators are looking at it. And so, we're kind of forming our business that way as well. But certainly, the regulations aren't nailed down yet, and that's probably one of the reasons why we're still sort of, asking where this is going.
Other thoughts on that?
My only other thought on that is that on the custody side, especially for active trading, you're talking about asset managers who are in and out of positions, is fine. Cold storage is not a good solution for an actively traded product. So finding that warm storage solution, like multi-party computation, for example, Blockfills, we use Fireblocks. They're a very, very good partner of ours. for our custody solutions. And then also you think about collateral calls or margin calls, on some derivative products or lending and borrowing. Those assets need to move pretty quickly. So there are some advantages to custodying with a liquidity provider, especially when you're doing the full life cycle of a trade, spot and derivatives and lending and borrowing.
Yeah, that's a good point. I'll just comment on that. In fact, today we announced a partnership with Computershare to provide cold storage. And I think the speed is definitely a factor. So the way we've kind of gone about it is to have a multi-party, multi-signatory solution where keys are off-chain as well as on-chain. So, but certainly, yeah, you're right. Certainly speed of execution is something that we think about as well.
Yeah. Just to add to that, on the exchange front, and this kind of ties into what David was saying earlier around these aggregators. What we're seeing is that institutional counterparties want to come in and trade through these aggregators that are tied into one or more custodians so that their funds aren't tied up at an exchange. They want to be as capital efficient as possible, and they want to be able to move in and out of positions across multiple venues as quickly as possible. There are several solutions out in the marketplace that do that, and CrossTower is partnered with several of those. I think that's a shift that we'll see in the industry where people want to be as capital efficient as possible. They don't want to have their funds tied up in a single venue or even a single liquidity provider. They want to be able to go until there's a NVBO. They want to go where they can get the best price. And where we've seen some exchanges have weird skews in pricing. ETH collapsed in one major venue in the US, and that created a bunch of ARB opportunities for people, but it also created tremendous losses for others, for the majority. So until that, I think that having a solution that's cross-exchange, cross-custody is going to be really important, and I think that is going to ease people's introduction into crypto trading.
Yeah, and as I said, custody seems to be top of the list for a lot of people, as well as the SEC. Every time I see somebody talk about their custody solution, it includes Fireblocks, which is a vendor out there. I think that's got hundreds of clients and sort of the plumbing, I believe, for custody. I know some of you are familiar. Can you comment a little on what they do? Because Fireblocks, when you hear them, it's like, don't try doing this without us, which is, I don't know, good sales pitch, maybe not, but what do they really do? Yeah.
Yeah, I worked with Fireblocks very early on when they first launched. Prior to joining CrossTower, I was at Galaxy Digital, and they were one of the first large desks to get on Fireblocks, and I believe even part of their initial investment group. But Fireblocks is an awesome tool. It adds workflow capabilities on top of operational workflows, on top of being able to store your assets, and they have a great network after being in the market for a couple of years, where you can easily transfer funds between the participants on that network. I know John Devine, as he mentioned, he uses Blockfills, Fireblocks, and Blockfills uses them. So I think he'd know more than me and on how they use that nowadays. But from my experience, it's a great tool.
Yeah, I'd second everything you said there, John. I think the big thing with Fireblocks is, number one, multi-party computation. You can move your assets really quickly. You have an option to ensure vaults. You can segregate vaults across entities. You can whitelist addresses, and then within their network, there's many institutional desks that are already plugged into the Fireblocks network. So transferring assets it's very, very simple.
Yeah, and again, we have no relationship with Fireblocks. I mention it because it seems to be one of the solutions that a lot of the players are starting to use, including BNY and folks of that caliber. And it starts to answer the question about, how can the industry meet the institutional trading needs? And it's sort of happening piecemeal, but less piecemeal than it was, and there seems to be some standards coming forward. Maybe we'll finish with what are the risks and how can firms protect themselves?
I can take a stab at it. So I think the risks as we enter this new market, really this new landscape, it's going to be counterparty risk. To me, it appears that the institutional market making, there's a lot of interconnectivity within this market, potential for domino effects. I think the best way to mitigate this risk is to diversify counterparties, diversify custody solutions, and utilize the margin that's available in this market, leveraging positions, using the derivative markets as well. I think those are all areas that you can do to mitigate some of these risks.
Yeah, and you're talking about kind of counterparty risks and typical risks. I think there are a lot of operational risks as well. I mean, if you transfer a coin to the wrong wallet, it's gone forever. And so
Yep.
that's the key risk that you face in crypto, and the first hurdle that everyone has to get over. And so you have to have zero tolerance for mistakes effectively, or you're going to wind up going out of business. So that's a simple operational risk that needs to be mitigated early on.
Yeah, that's a good point. I breeze over it a bit, being around a while for now. So having a good order of operations on how you custody and how you transfer assets, utilizing test transactions when integrating with new wallets, new addresses, those types of procedures need to be well defined, before you even begin trading.
Yeah.
Absolutely. I'll just add on that. I think it's one of the reasons we as Brain Capital harp on the segregation of duties and segregation on multiple levels. First, as I said, we're segregated at arm's length from exchanges and market makers and dealers, but also within our organization. Prior to sending any crypto out of our what we call our vault, it goes through a number of approvals, along with our chief compliance officer sign off. It's a little clunky, but I think it's well worth it given the downside risk. Right? So.
Two other areas that traditionally have been hard to find services in the past were banking and insurance, and there's more available in insurance now than there used to be. Most of the custodians and exchanges are insured the hot wallets up to 100 million, and then everything else is held in cold storage. The banking side I only mentioned because it's funny that it's not that long ago that Barclays dropped Coinbase as an account, and I think Coinbase's market value is no higher than Barclays. So interesting times. There's one last question here. What does the future hold?
Yeah, I think some of the things that I would expect is that there's DeFi has a bright future. I think DeFi is sort of the somewhat of a finance 3.0. I think traditional finance moving into DeFi, maybe even central bank digital currencies, making their way into DeFi would be somewhat of the future. Regulators walling off DeFi so that regulated institutions can safely trade on there or easily trade on there. I think DeFi is going to be big, and everyone's going to have one foot in it.
I think you're dead on. The DeFi is going to be big, but DeFi is an enormous, an enormous subject with a million different pieces to it. But from my viewpoint, what I see is the tokenization of everything, and what that means is that the rails that are being built on the blockchain today, our layer 2 rails, will be used for for the trading of all kinds of things that are currently on the traditional rails. I would keep an eye on FTX because they are really the market leader in the space, and they are really pushing 24-hour, 24/7 stock trading, having launched a tokenized version of stocks over in Germany for non-U.S. investors, which has started to be pretty popular. And there's a little bit of there's a strong push for the world to kind of look more like the rails that crypto trades on right now, and away from the rails that the traditional world trades on. So I expect more and more tokens to be traded, more and more tokenized CDs, et cetera. All of those things are going to become more proliferate and are on a daily basis.
Audience, any specific questions for the panel? So I have one that goes back to my FX days. In FX, people used to pass the book around the globe. So, starting in Asia, then coming into UK and into the US, people would pass the book and, trade. Does the same thing happen in crypto? I mean, one market is open, the other one is actively trading. And does the liquidity profile change throughout the day?
That's a great question. I don't particularly see dramatic shifts in participation across tokens on a regular basis, or something that could be well defined. Maybe some of the other guys are seeing it differently, but I'd say the top 10 assets, the volumes tend to move together. That's just from my view.
I think what you may find is that there might, depending, since it's 24/7 and it's global, local news can affect the global market. So, when you go to sleep in New York, things look pretty stable and on the up and up, and then you get some news out of China, and all of a sudden, when you wake up, you see that that asset has tanked or has lost 10%, 20%, and that's not unusual in crypto. So I think that the 24/7 cycle will change how global trading desks operate a bit, because there's really no sort of end of business day. You have to define that and figure out internally how you're going to close out those positions. But yeah, it's a interesting industry with 24/7.
I was just going to elaborate on that just a little bit. That's where better data integrity could really help the industry. And FIX is obviously extremely high data integrity from our perspective, and so we data integrity is everything, because you don't really know in this kind of 24/7. There's no stop and start time, and so that's a place where the protocol could really add some value to the industry, I believe. So anyway.
Yeah, and again, we're not making recommendations, but if we're making recommendations, it will be to trade, the most liquid coins on the most stable exchanges. Having said that, Ethereum and Bitcoin are the big dogs right now, and beyond that, people are putting together baskets of other assets that can be traded. But what percentage are they of the market right now, and what's the correlation between those two and the rest of the coins that are farther down the list?
I'm going to take a stab at 60% and 75% correlated, just a guess.
Yeah, the hot topic right now is that Ether Bitcoin spread. That's what seems to be driving a lot of the action past week or so, I'd say. And the spread markets across the board drive a lot of this stuff. So it's very, very interesting to keep an eye on the spreads between these top 10 coins.
Maybe this is directed at the market makers, but what's the best way to execute a large trade? And what is large?
Yeah, you can do TWAP, VWAP type execution, or you can utilize the dark pools. Blockfills has a very deep dark pool. We have aggregation from over 35 sources, and a large order is 50 million to 100 million, I would say. And with the dark pool, you can get those things done pretty well without pushing things around.
Okay, I think we're at our allocated time there. Thank you very much for participating. Again, to everybody who's joined us. If you have any questions or any topics you want to touch on, please follow up with myself directly, or any of the panel will put you in touch. And thanks again for your time.